Welcome to Your Average Investor. We're going to talk today if SoFi is a buy or a sell, or where the heck it's going with its stock price that just seems to be eternally range bound between $7 and $10 per share. Now, if you're not familiar with SoFi, the first thing you need to do is subscribe to the channel. After that, we'll give you a quick overview here. SoFi is a all-in-one banking and loan management and finance management platform. They're competing with the likes of JP Morgan, also Robinhood, and a lot of other financial lenders. So you can see here what they have to offer. They're building an all-in-one shop for it. Personal loans, banking, credit score and insights, mortgages, student loan refis, investing, so you can actually use them to invest in the stock market if you want them to be your broker. Private student loans, credit cards, insurance, travel, all in one place for general financial health for the general population. It's actually pretty cool. Now, in spite of that, the question still remains, are they a good stock or not? What should I do with them? Well, actually, let's actually pull this back up. I'm going to go to FinViz real quick. This is a great site to use if you want just a very quick overview of a company's financials. I like using them quite a bit. So here we've got a couple of interesting things. We've got book value per share and cash per share. So cash per share is sitting just under $4 per share. And you can see all of their metrics here as well. So their market cap right now is just over 7.3 billion, and they're doing sales of 3.21 billion. Now, in context, you need to know context here, right? So their main competitors would maybe be like JP Morgan or something like that. Oh, looks like we gotta get rid of that. There we go. So let's look at JP Morgan, right? So JP Morgan, similar company in terms of in the finance industry. They have a book value per share of $106, and they're currently sitting at $190. And they've got an income of $48.5 billion and a market cap of almost 550 billion. So about 11x market cap, income to market cap there. Going back to SoFi, you can see again their book value per share at 5.5, their current share price just under $7. Not that far off book value per share compared to the current share price. And you know, we could do this with any number of other banks. We could look at BAC, we could look at Wells Fargo, we could look at any number of them. So here's BAC, book value per share $33. Current stock price is just above that at $37 per share. From a fundamental standpoint, it doesn't look too bad. They've got a very good business going. Their EPS has recently turned positive, so they're now making money instead of losing money every quarter. And it's not your typical SPAC. We had a big SPAC mania back in 2019, 2020. Lots of trash companies coming out to the market. SoFi may be a hidden gem among those. It's up to you to decide. I really like it, actually, and I'm going to show you why in a minute, besides just their financials. So if we go, let's go to analyze here so you can see. So here's earnings per share, 2019, minus 0.33, minus 0.4, minus $1, 40 cents, 36 cents. They're coming and inching their way into profitability, and it looks like this year they may actually turn the corner and turn profitable. One of the big reasons the street doesn't like SoFi, and a lot of other people you'll hear negative things about SoFi, is because they've got a large book of student loans, and with student loans being paused, there's some questions around whether or not they're going to be able to make money off of those, or if that large book of student loans is going to cause them financial distress. That being said, they are very diversified in what they're doing. So student loans is obviously one part of what they do, but if we go back here, you can see there's a whole host of other things, from credit cards, personal loans, banking. I think if I remember right, they got their bank charter something like 18 or 24 months ago, and that was a big deal so that they could be an actual bank for customers' funds. Now, I'm going to show you something else that's kind of sneaky that I found out about SoFi. Let me see if I can just get the URL to show over here. All right, here we go. Oh, it's not going to work, is it? Hang on. This will all get clipped out of the video. Okay, so check this out. This is what I found to be really interesting with SoFi. We're going to look at their all-time traffic here and look at this trend from 2015, right? So they went public via SPAC right around here, and since then traffic has just grown exponentially, and they're now sitting at about 1.8 million searches per month for SoFi. Now let's look at some other big banks, right? Let's look at like JP Morgan. Let's look at I don't know, like Wells Fargo. I'm gonna take just a couple of these guys' home pages here. So we're gonna look at JP Morgan Chase. And this isn't necessarily an apples to apples comparison, but it's interesting. It's interesting to look at regardless. So here's JP Morgan's traffic, right? For whatever reason, huge spikes in traffic back in 2013 through 15. Comes down 2016. There's 2019, and they've got plenty of traffic, but 1 million searches a month compared to SoFi's 1.8 million organic searches a month. Let's look at Wells Fargo now. And then we can look at BAC if we want to too. But I want to get into some technical analysis. So here's Wells Fargo now. Wells Fargo gets, let's see what they get. Wow, that's huge. 22 million searches a month. So Wells Fargo takes the cake here for searches per month. But still, the point of this is just to say, not that SoFi is going to be bigger than JP Morgan, but to say that they compete on a scale in terms of search volume with JP Morgan. Wells Fargo, for whatever reason, clearly let's look at Bank of America, actually. Bank of America. I wonder if these guys have something similar with like 22 million search results. Or 22 million searches per month. Alright, yeah, look at that, 26 million. So maybe something's just up with JP Morgan. Maybe JP Morgan operates in a totally different SEO space where they don't really care about SEO. Very interesting. So maybe I'll have to rethink my analysis on SoFi here, but in terms of how relevant this is specifically when I'm talking about, looking at SoFi with the search results. But the trend is important, where Wells Fargo, Bank of America, they're kind of flatlined. This is a very positive upward trend and a growing trend for SoFi. And my thought is on this is really why I like the stock, is it's like, all right, well, if SoFi is going for the big bank play, I'm thinking that at some point in the future they're going to pay a juicy dividend. Look at JP Morgan here, right? So JP Morgan, this is back in like 1985, 1986. They're trading at between $18 and then all the way down here, $3 per share. I think that's the all-time low adjusted for stock splits for JP Morgan, which JP Morgan stock split history. Let's see what they've done here. Yeah, so they've done a number of stock splits, 3 for 2, 3 for 2, 2 for 1, 3 for 2. So they've had a number of different stock splits, but adjusted for stock splits, when JP Morgan was first, a few years into their IPO, you'd have been getting them between $15 a share and $3 a share. And then they had a nice run here all the way up to about $68 a share, $67 a share. Great financial. Oh no, this is the .com. We're way early. Hang on. .com bust here, moves back up. Great financial crisis down here. But this is what's interesting, right? So they start paying a dividend here in 2005, 2006, about 20 years after they IPO'd. And at this point, their dividend, 34 cents per share, and their trading price is about $45 adjusted for stock splits. So we'll call it it's about a 5% dividend yield. But if you bought back here for say like $5 to $10 per share, your dividend yield based on your cost basis is going to be more like 10% per share. And now if you go fast forward all the way till today, what JP Morgan's dividend, they're paying a dividend of $1.15 per quarter. $1.15 per quarter, 4.6 per year. So like if you're buying right now at current stock prices, divide that by what, 190, you're getting about a 2.5%, 2.4% dividend. It's like, all right, whatever, it's a bank stock, I'll take that 2.4% dividend. But if you bought, if you happen to nail this dip right here and you bought at between $3 and $4 per share, you're having 100% of your cost basis returned to you every single year in dividends now in 2024. And granted, so this is what, 1990. That was my mistake, because I wasn't buying JP Morgan the year before I was born. But now, if you had held that whole time, you're getting returned literally your entire cost basis in dividends every single year. And so I'm looking at SoFi going, all right, SoFi is going the banking path, right? Let's look at SoFi. Let me pull SoFi back up. And if they take another 5 years to announce dividend, or another 15 years to announce dividend, that's okay. I think they'll still have appreciation in stock price, and that's good. And if they start paying a dividend sooner, that's great too. But I think they'll probably not pay dividends now so that they can continue to reinvest in growth and then grow faster and pay dividends later. And let's just say they follow a similar course, and look at this. We got a low of 4.22 per share. So maybe they do a couple stock splits and whatever, but we'll just pretend that's the low, and they, over the course of 15 years, get to where they're, maybe between $20 and $30 per share again, which was their their boom post IPO. And I'd maybe we see that sooner, but I think that's more likely we see that in like over the course of 10 or 20 years. But then let's say they start paying a dividend, and the stock price is at $30 per share, and they're paying a dividend of of 2.4%. It's like $30 times 0.025. So they're going to be paying a dividend then of 75 cents per year. And if I'm buying right now at about $7 per share, well, that's a dividend of like what, 12%? Divide that by 7, 11%, just under 11%. So I'm getting an effective 11% dividend on top of the appreciation that I might have. And of course, over the next 40 years, as they continue to grow, if they continue to perform well and continue to pay out increasing dividends, then eventually that will become even more of a big dividend, big win right here. So I'm going to be working on building up my position. I've got a position already, full disclosure. I'm going to be working on building a bigger position over the next several months, and I really like it from that perspective. Now let's look more technical analysis for just a second. I'm going to move into the 1 day chart. So each of these is 1 day, and look at just a couple of things. So I'm going to zoom in just on the last about 2 years here. So last couple of years, we've got what I would call two major ranges of what it looks like. And I generally, when I do my technical analysis, I like to do it with straight lines that just show where are people buying and where are people selling. I know you can do trends up and trends down and things like that, but in general, this works best for me. It's very simple, and I quite like it. So here's the initial range for SoFi, right? We've got a low of around we'll call it $4.50 maybe, and then a high of about $8 per share. And then this right here, we had a breakout where it broke out the $8 per share and climbed, and then came back down, retested on this support zone of about 8, climbed up again a couple times, all the way up to 11.5 per share. And then it moved back, and then it's breaking back down into its lower range, breaking back up. And so it looks like maybe we're establishing a new range right here, where maybe I'd say the floor is now somewhere in this range of like $6.50, and maybe the ceiling is now like $10.50. Where's my? There we go. So maybe that's our new range. I think I can get super fancy and even like, yeah, look at this. I'm gonna make this one orange. Beautiful. We're gonna get real fancy with it here. So that's really the range, right? So you had the range post IPO, or and then after that it just sold off like mad, along with a lot of the market, and then it's established these two new ranges here. So I'm thinking this looks like a pretty good range to start buying in. I'd be buying heavy if it dips back below 6. I'm buying at a pretty standard pace right now, as it's in this $7 to $8 range, and I like it as a long-term play. Now, if you're looking to trade this for the short term, there's lots of different ways to look at it, right? You could see this as a series of lower highs, right? You've got a high here of 11.6, then you've got a high here of 10.4, and then a high here of 9.7, and then 9.1, and maybe you consider this the next high of 7.9, And so you've got a series of lower highs you could be looking at, but you could also look at that in this range and say, okay, so it's descending and then it broke out, and now it's descending, and we're gonna have another breakout to around the 9.5 to 10. There's a lot of ways with technical analysis you could look at it. My favorite is just straight lines. Where are people buying and where are they selling? Right? That's what I like to look at. So from a technical perspective, I think this has a pretty good risk reward. Likely it moves back up. I could see it moving back up into the $9 range before it moves back down to the $5 range, if it ever moves back down to the $5 range again. And so to me, that makes a lot of sense. Now, if you're interested in further mitigating risk on a trade like this, something you could consider is selling covered calls on the position. So let's say I bought 100 shares today at $6.94. It cost me $694. And I wanted to both cap my upside, but also if I thought, there's a pretty good chance that they move back down to like $6.50 or something like that, just based on whatever I might be thinking. So then maybe I'll go 30 days out right here, and I'll say, okay, I'm gonna sell this call 7.5 for $24, right? So I'm gonna sell this for $24. And what that's going to do is it's going to protect me against this potential downside right here, right? So if SoFi moves from 95 down to 65, that's a $30 loss if I've bought 100 shares. But if I sell that call for $24, then I've only lost $6. Now, if on the other side SoFi goes up to, say, 7.6 per share or 7.8 per share, my gains are capped. I'm capped at 7.5, right? That's where let's add a little arrow or something like that right there. So we've got that's where my gains are capped at a 7.5. However, because I made $24 in premium, really, as long as SoFi is trading below 7.74, I haven't lost out on any potential gains. Now, if it skyrockets to like $9 or $10 share, sure, I lose out a bunch there. But in this case, it's like, okay, well, if as long as it's trading below 7.5 by expiration, that contract's going to expire worthless, and I'm going to be looking really good. Even if it's up to 7.74, in this case, if my position gets exercised away, I can just immediately buy it back at that price and I'm break even. Or I could look to roll the contract, most likely another 30 days out, and move the strike up into the mid 8 range, like 8.5, or maybe just 8 in general. So that's an interesting way you could play it. Now, covered calls aren't going to be a perfect hedge here. I mean, a great example of that is AMC. Let's say you thought the same thing about AMC, right? And you're like, oh, I'm going to buy a bunch of AMC because it's on a dip, and I'm going to sell some covered calls on it, and then they just crash down, 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 down. I mean, no amount of selling covered calls is going to help you recover that position unless you're willing to just sit in this position forever and then wait and see if it comes back up. So it's not like it's a foolproof strategy. And then, of course, on the other side, let's say on the other side of it, we've got something like, let's see, what's something that just spiked hard on earnings? I think Eli Lilly? Did Eli Lilly move up on earnings? Yeah. So let's say I was selling covered calls on Eli Lilly, which would be, you'd make a lot of premium from that. So let's say I sold a covered call for like 7.5 here, and then it spikes up to almost $800 a share. Now it's back down, but let's say it spiked up and it never came back down. Well, in that case, I might just be getting my shares called away, and it would be pretty dang hard to get those shares back without spending extra money for them. So there's that risk too when you're selling covered calls. But overall, I like SoFi. I'm invested in SoFi currently. I'll be buying more SoFi, and I'm planning on holding this for the long term for now. Hope you enjoyed this video. Please drop a subscribe, and we'll catch you on the next one.